are aware of the events that Evenco brings together with both asset owners and fund providers across Europe. And this is the fourth of a series of webinars that we have done in conjunction with Evenco on topical, interesting issues to discuss with an ongoing, evolving group of very intriguing panelists. And so what I'll look to do at this point is give a brief intro with our three panelists, and then we'll dive straight into the agenda of today, which is to look at implications of ongoing supply chain challenges to the investment world. With me is Patrick Sanner, head of macro strategy from Swiss Re, Antoine Denis, head of advisory for Bank Suisse, and Phoebe Stone, who's partner and head of sustainable investing and head of intermediary investment services with LGT Wealth Management. And what I'd like to do is ask each of you to give just a little bit more background to flesh out who you are and why this is an interesting topic above and beyond just the title, if you will. So Patrick, shall we start with you?
Sure, yeah. Thanks, Tim, and hi, everyone. So as alluded to by Tim, I'm Patrick. I'm heading macro strategy at Swiss Re. That means I formulate the global economic, inflation, as well as interest rate views, and I also design and estimate a lot of the alternative scenarios that we use. And in this capacity, I'm also part of the investment committee of Swiss Re. The reason why this is very important is because ultimately Swiss Re, as a reinsurance company, is very active in the real economy. We invest in the real economy. We insure the real economy. So anything that relates to supply chains, climate change, these kinds of topics is something where we have an inherent interest.
Oh, very good. Phoebe, shall we get your perspective?
Yes, hello. Thanks for having me on today. So I head up our intermediary investment services portfolio teams. So those are the portfolio teams that run multi-asset portfolios for the intermediary market here in the UK and internationally. But potentially somewhat unusually, I'm also head of sustainable investing. That was my previous role, so I come from a sustainable investment background. And I think this topic really is a great example of how important and why issues around sustainability, issues around climate change and resilience of businesses and the strategies they have in place are quite so crucial to every investor. These are not issues that should just be isolated to the consideration of a sustainable multi-asset investor, but absolutely across the board. So really pleased here today to be fleshing that out and hearing some views of my fellow panelists.
Oh, very good. And Antoine, last but not least. Still on mute, Antoine.
Okay, unmuted.
There we go.
Yeah, sorry. So first, thank you for inviting us. So I'm heading the advisory for SEED's private bank. So the SEED group basically is a $27 billion US dollar bank. And on one side, we manage portfolios. On the other side, we advise our clients as well. So we try to give them some perspective. So this is why supply chain is really important to us, because there's been quite in the discussions in the last year, and we probably will for the next 10 years, quite a core thematic for and perspectives to have for our portfolios. So for us, indeed, it's really important to understand this aspect and to understand the implication for portfolios, being for equities, fixed income, rates, currencies, commodities, you name it.
Very good. And I'll return the favor. As I had said up front, I'm one of the senior European equity strategists at Bloomberg Intelligence. And I also work across the globe with our teams on broader important thematic issues. And I would agree with what every one of our panelists have talked about from the standpoint of the importance of supply chain as an issue whether it's tactical and what's going on with cost or availability right now of inputs, or taking it very longer term, very much longer term. What are the implications on sustainability and the ability of companies and economies to ensure security, whether that's food or energy, etc. And so there's lots of investment ramifications to explore. I think all four of our organizations have done a good bit of work about this, and I'm sure we'd all be happy to share. I will also just make a personal note so you don't think it's really odd. I'm wearing what I'm wearing, which is rather informal, because I had a little biking incident a couple of days ago and broke my arm. So at any rate, that's why the sling is here and a formal shirt is not on. So please do pardon me for that one. So let's dive into this. Certainly, there's lasting impacts from COVID lockdowns that brought supply chain to the forefront in many ways over the course of the last couple of years. Russia's Ukrainian invasion served to amplify all of this in various ways, to where we've got distortions that continue to impact many sectors and markets relative to what was sort of assumed to be the globalization norm. And what we'd like to do is dive into a handful of topics over the course of the next, call it 45 minutes or so, and see what we come up with. Let's start with maybe the most proximate item at this point, both from the standpoint of Europe as a geography, but also temporally in terms of what's going on right now. We're coming up to almost 1 year since Russia invaded the Ukraine. And, it's a good thing it's a bad thing, but to dive into what are the lasting implications from a supply chain perspective and how this is impacting your investment perspectives. And, Patrick, why don't we go ahead and start with you on this one? And, we can go around the horn on this, but also feel free to interject.
Sure. Thanks, Tim. So I think there are a couple of things to consider. First of all, I think the topic of resilience and self-sufficiency has become a much more public topic and debate in a variety of countries. And I think that the Ukraine war, as well as COVID, have meant three very concrete things for the real economy. First, a realignment of supply chains to insulate economies against future trade disruptions. So that is one thing that a lot of people are now much more urgently thinking about. The second is the added impetus to the green transition, given the worries over energy security that Russia's invasion of Ukraine has sparked. And the third is really higher food prices and the potential for global food shortages, which are also increasingly on people's minds. And all these things are now being prioritized, which weren't as high on the agenda as they are right now, even 5 years ago.
No, very good. And Phoebe or Antoine, if you want to add any other perspective.
Just to add something, I think it's kind of interesting that the business community or the investment community didn't learn more lessons from COVID, and it took the outbreak of war in Ukraine to really identify the risks in this non-diversified sourcing approach to raw materials or developed materials, manufactured materials, and the routes in which those commodities or otherwise are actually reaching individual countries or trade blocs. And clearly the war in Ukraine has very much put that on the map. Echoing something that Patrick said around the green agenda, it's interesting to think about the fact that the Build Back Better Act in the US, which was restructured, renamed, etc., would that have been passed, given the challenges politically in the US, if the war in Ukraine hadn't happened? Would that political agenda behind energy security, even food security, have been magnified in the way that it would have done otherwise? I would argue potentially not. And so I think that the the political forces have certainly identified the risks behind interconnected supply chains and, more importantly, non-diversified supply chains in a way that they hadn't previously, even with COVID.
Oh, fair enough. And Antoine, anything to add?
Yeah. Yeah, maybe I'd like to build a bit on what just Phoebe said regarding trade blocks. And I think this is a very interesting perspective. So we have not learned many lessons from COVID, and we have been waiting a bit for the energy transition and thinking that energy transition and green energy is just easy to have. But now, you know, regarding trade blocks, one thing crossed my mind is that now we have more of a east-west divide. And basically we have two big blocks, and you could find new names for this, but basically you have on one side the sanctions and on the other side the non-sanctioned countries. And basically in this context, we need to redefine the borders, we need to redefine supply chain, and of course comes up the food security, energy, as you both mentioned. So in this area, my perspective and our perspective is that in terms of investment implications, you tend to have more as a consequence reshoring or nearshoring or +1 shoring or allied shoring, whatever. And in this context, of course, you have some risk and opportunities as always in terms of investments. And probably one of the risks and for the investment landscape is regarding as well, among other things, but inflation. Because reshoring implies some more inflation, so we might have some impact from an investment perspective, especially on rates. For example, you can think of the USD, the almighty USD, that is not anymore the major currency, or you already see some shifts. Some countries are using already some renminbi a bit more. They're not shy about this one. And on the opportunity side as well, you know, some countries will benefit from that. You know, the Chinese +1 strategies will benefit to some countries and to some sectors as well. And yeah, we need to reorganize the energy grid as well.
Oh, very good. And look, no, that's all good. And all three of you, I think, hit on various points that maybe we'll dive a little bit more into with successive questions. You know, we hit on a couple of different fronts with COVID, and you know, there's broad ramifications, and clearly we saw supply chain disruptions and whatnot. But some of those have passed in various ways. Some have yet to be, you know, fully reconnoitered. But an interesting aspect of COVID clearly has been China, with the, you know, the ongoing zero COVID policy lasting for so long. Clearly, that's gone. That decision it was made overnight, and it was made abruptly, far more than frankly what we thought would have been a relatively slow opening. With this reversal in place, how are you thinking of that sort of broad decision? Are you an optimist about China reopening, and that could be both, you know, as it relates to supply chains, where there were still some issues, or its impact on underlying demand? Or are you a pessimist? And if so, why? Phoebe, do you want to start this one?
Yeah, I think it's interesting that a lot of investment commentators or analysts are extrapolating out the effect that we saw when the US came out of lockdown, and assuming that these really high savings rates are going to automatically go into either domestic Chinese companies in terms of reflecting in demand, or potentially overseas companies reflecting on demand. Now, we know that culturally, the US and China are very, very different parts of the world, very different cultural norms, and the use of money and the savings, household savings, which have gone up substantially more actually on a relative basis versus the US in the same sort of time period as a result of the COVID lockdowns, may not be spent in the same way. There's a lot of analysis looking at the proportion that's being spent on international travel. There's also a lot of analysis demonstrating how much money is likely to go into the stock market because of the way that and this is a very general generalization, but the way that the Chinese people interact with the stock market is very, very different to the historically how we've done so here in the West. So I don't think there's this automatic assumption that you're suddenly going to see a wall of money going into domestic demand, consumer-led demand. It doesn't mean it won't happen, but I don't think that should be an automatic assumption. I think the other factor that we need to take into consideration is this is not just COVID lockdowns being over. There's a lot of stimulus from the Chinese government at the same time. They are really motivated to get growth rates back up. They're being a lot more kind, for want of a better adjective, to certain sectors where they're extremely militant, and places like the tech scene and Jack Ma's ability to get financing, when obviously previously that was absolute no-go in terms of the IPO of Avant Financial a couple of years ago. The support for the property market all demonstrate that there is considerable motive to getting China's economy back up and running. And I don't want to seem like a pessimist, because I don't think I sit on the strong pessimist or strong optimist side of things. But I definitely think there's an opportunity selectively to be investing in domestic Chinese businesses. There is a very, very fast growing middle class in China, probably one of the most cliche statements that you could make. But I was interested to see a Credit Suisse report which demonstrated that the median income in China for an adult is actually higher now than it is in Europe, including Eastern Europe. So that really demonstrates quite how much financial firepower these individuals have. And given the savings rate, we may well see some come through. Whether or not the market's got a bit ahead of itself already remains to be seen. And obviously we've seen a bit of a correction in recent weeks.
No, very good. Antoine, thoughts on China initially? We'll hit this on a couple different perspectives.
Yeah, no. I think I'm probably even more optimistic than Phoebe. So I'll take this hat, believing that, on both sides, on the supply chain side, it's quite a big relief for the world, and on the demand side as well, it's quite a relief. If you think that growth in China will be probably one of the biggest oxygen the global world needs at the moment, and so this is quite a positive here. Regarding specifically to China, we have been actually quite positive and bullish since November. So it's a mix of luck as well in here. But one of the big trigger, of course, was the end of the COVID lockdown, the end of 3 years, actually a very strict COVID lockdown. So I think I don't need to elaborate on that regarding the savings, as I think it was well described by Phoebe here. But on top of it, there was a lot of many things happening, especially after the Chinese committee. So, and we had a lot of relief as well regarding real estate. So the 3 red lines are about to be relaxed a bit. So government is being more supportive here as well. They're in a better position regarding inflation. So they're able on the monetary side to push a bit more the economy. So yeah, this is probably a good thing to have. And regarding the long-term perspective as well, it's just to say that it's not just a question of COVID, it's the long-term perspective as well. That if you think that the GDP of China is like 20% of global GDP, and regarding equities, if you have only 4% of equities for this 20% GDP, I know it's not that simple, but taking big perspectives here is probably somewhere to be. Then it's not just about China as well, it's about Europe that is quite sensitive as well to this Chinese economy regarding exports, regarding as well on the value side regarding equities. And finally, speaking of commodities, then it will spur probably some more demand if you think that China consumes 50% of global copper production. I mean, it needs to happen somewhere when it's supply constraints. So yeah, for us, it's definitely a plus.
No, very good. And Patrick.
Yeah, I mean, maybe a couple of things to add. One is on the supply chains. If you look at and kind of the related bottlenecks, but if you look at a variety of measures, then it does suggest that most supply chain issues, as well as bottlenecks as they relate to shipment and the production of goods, are by and large resolved already. So the reopening really only has most likely marginal impact, marginal positive impact in terms of resolving supply chain bottlenecks, because they, again, by and large, are already resolved. I think the impact that we're seeing is probably a mild but global net inflationary impact. Phoebe had just alluded to it before, and Antoine as well, that the inflationary implications also need to be a little nuanced, in the sense that the larger implications are probably for the economies that are closer to China. We are seeing quite a bit of consumption related indicators pick up, for example, in the domestic travel data and so on. But because it's not a primarily investment-led recovery, we don't expect a significant inflationary impulse out of China towards, for example, the US or Europe. But because it's most likely going to be a consumption-led recovery, we think that the net inflationary impact will be staying more in the region.
No, very good. I have to say, this is maybe the most optimistic set of three people, even if, Phoebe, you didn't want to put yourself totally in the optimistic camp. When I've had discussions with others on the China question, I tend to be in your same camp from the standpoint of some of the elements that you've pointed out. And our China strategy team, as well as underlying analysts, had I think very, very quickly taken with the idea of some of the things that you all have pointed out from the standpoint of pulling back on the three red lines in property and all the stimulus that has transpired. So it's quite interesting. Let's stay, though, on China and maybe the flip side of tensions between China and the US. Now, clearly, an awful lot of this is revolving around the world of technology. And clearly, there are supply chain questions from the standpoint of where does this trade relationship go that's been so crucial. I have to say, our group, our technology team, had done a pretty interesting piece a couple of months ago between our Asian team and our US team, looking at unraveling the US-China tech supply chain and how easy would it be to do if you really wanted to, if companies really wanted to, between now and 2030. And our basic synopsis is, it's definitely not easy. And, I'd be happy to share that report with anybody who'd be interested to take a look at the details. But suffice to say, what are you thinking about with this geopolitical tension feeding through into trade issues? Are you worried, or do you think of mountains being made out of a molehill and things will smooth out? Are there things you're specifically doing from the standpoint of positioning as it relates to the China-US sort of political divide or tension? Antoine, do you want to go first this time?
Yeah, why not? Because initially I said about the East-West divide, but as well we can think of a multipolar world, which is a bit more fragmented. So probably reality will be between those two, where the world is going. So I think we can a bit forget about the full globalization process at full power. So yeah, this is a risk that some of the tensions divide a bit. Now as well, we need to take into account that, if you think of China, this is one of the main partners of the US. So, the US, they always think about business as well. So I'm not sure we'll have pure multipolar world or East-West divide here. But as well, I think things and the world will adapt. As we mentioned, the supply chain will adapt as well. But the key things need to be taken into account, and we'll have some risk definitely, but some opportunities as well. So as I mentioned about the reshoring, nearshoring, etc. And the need as well to probably rewire the grids, give more security, redefines the borders. So a lot of things is happening here.
Sorry, I am at home, as you can tell, and I was muted for a second because the dogs were barking. So, Phoebe, thoughts on U.S. China?
Yeah, so we've obviously had a bit of a wave of policies put into place by the US to look to mitigate some of the risks of the dominance of China in tech, but very specifically in climate change tech and the green transition technology, specifically around things like semiconductors, triggering the US to look to build their own industries. Interestingly, Europe's obviously responded in the same way. And when you look at the charts in terms of the level of investment of China versus other parts of the world, from 2014 up until the end of 2022, China had invested over $1 trillion US dollars in the green transition. The US at that point had invested less than 500 million. So far exceeding double the next biggest investor, really demonstrating that gulf when you're thinking about it in monetary terms. And clearly the US politicians are very aware of that and reasserting their dominance in an area that's clearly extremely important, war in Ukraine, as well as for other reasons, and using the kind of trade tensions to try to reassert a little bit of authority, a little bit of control. But unfortunately, still 70% of all strategic metals are processed in China. There's a really incredible report, which might be linked in the report that you mentioned, Tim, which was released by the International Energy Agency last summer, so July 2022, really investigating the interconnectedness of supply chains within the energy transition globally. And whilst things like lithium or titanium or copper, nickel are mined in some regions of the world, I'm not going to say very many because it isn't very many, but it's at least some diversity there, that reduces to extraordinary levels when you look at the level of processing. So yes, okay, there's maybe a bit of reassertion of dominance or reassertion of skills or expertise of businesses to Europe, to the US, even to places like the Middle East, very, very recently. But the major challenge here is actually the processing of those strategic metals, which, as we know, go into everything from a wind turbine all through to a solar panel, electric vehicle, battery, la 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 la. You don't need me to list those things. So yeah, I think that that tension, that trade tension, will still continue to rumble on. And much like the report you mentioned, Tim, it's very clear in this report from the International Energy Agency that it's going to take enormous levels of investment from places outside of China to really rival the fact that they've sewn up effectively the supply chain connected to the green transition.
No, indeed. And Patrick, anything to add here?
Yeah, I would say, I mean, so we did quite a bit of analysis and simulations actually on this topic of friendshoring and reshoring, and I think what people often do is throw the two approaches into the same bucket when the actual economic implications are very different. So reshoring basically means that you have a production facility or site and you bring that home domestically and you produce it there. Friendshoring basically means that you bring it closer to home, but you don't necessarily produce it in your country. It can be, you know, within a satellite kind of country that is reasonably close to your trade routes and so on. And, you know, you asked before about, you know, where do you see the opportunities? Well, the opportunities depend a lot on whether we are talking about reshoring or whether we're talking about friendshoring. So in our analysis, for example, if you take a reasonable reshoring scenario, then it's clear that Germany, the UK, and the US would, within the advanced market complex, be the biggest winners in terms of positive economic impact. And from the emerging market side, Vietnam, for example, and Mexico would be the biggest losers. But if you think about friendshoring, then actually the impact is exactly the opposite, where Mexico, Vietnam, as well as Central and Eastern Europe would stand to benefit most from that approach. So it just goes to show that it depends a bit, which type of supply chain recalibration we really talk about. And then based on that assessment, you can then think about where do you want to allocate and how do you want to approach that strategy going forward.
No, very good. And it is interesting. I'll get to this a little bit later, but deglobalization, in various ways is occurring, but there's reglobalization that I think is also a very important twist that goes to what you were just referring to, Patrick. Look, Antoine, you had mentioned a couple of times friendshoring, reshoring, however we want to phrase this. Patrick, you just touched base on it. I didn't want to talk about the topic. Is there anything specific, Phoebe, that comes to your mind or perspective when it comes to this sort of reconnecting of supply chains that you also wanted to throw out?
I'll link to a tangential point, I think. Friendshoring or reshoring potentially has risks if the original supply chain location strategy has considered things like the physical risks behind climate change. So quite obviously, businesses that are manufacturing things in parts of the world, let's think of Southeast Asia, particularly vulnerable to climate change, physical climate change risks, clearly need to diversify across different parts of a country or different countries in order to mitigate against, let's say, an enormous flood in Thailand. And we know the automotive sector has been hit several times in the last couple of decades from this sort of situation. And the businesses that spent the time to analyze and model that physical climate risk and situated their factories in areas where they could quickly switch production, or at least rely on a proportion of the production, were able to mitigate that. So if you're suddenly friendshoring or reshoring to a part of the world that's a lot more exposed to physical climate change risk, and this is not something that we need to be thinking about in 10 years' time, we're all very aware this is a right now problem. You could be sort of fixing one problem with regards to vulnerability of the length of a supply chain, but giving your business another problem with regards to locating in a part of the world that's suddenly more exposed to things like flooding or drought, etc. And in terms of mitigating that from an investment perspective, that's really challenging. But doing location-based modeling for a company and for their supply chain, and you can get some of that access to some of that information using FactSet, using Bloomberg, of course. Sorry, to mention the other contender in that conversation.
Yes.
And then overlaying that with geospatial imagery. It's not perfect, but it comes out with some quite interesting analysis, company or sector by sector.
Oh, for sure. I would say, to your point, somewhat tongue in cheek, but very seriously as well, that our group within Bloomberg NEF, that does an awful lot of climate change oriented analysis on all sorts of new energy. Overlaid with the BMAP functionality on the terminal, provides some pretty interesting insights from the standpoint of exposures in various geographies. There's a couple of things here that I can't hit on in one question, but we can take in two different tracks. One is this issue of climate change and how is that impacting supply chains. And since Phoebe, you just brought that up, maybe we'll stick on that one, and I'll come back to the second item, which deals with India in a moment. So I don't know, Antoine or Patrick, one of you all have any perspective as it relates to climate change and what's transpiring with, Lord knows, what we've seen from the standpoint of both weather as well as any number of other issues and supply chain that you wanted to throw out or add?
I see no one's rushing for this one, but no. So I'll start with something. Definitely, I'm not a climate change specialist, but I would say two things basically. That one way looking from an investment perspective, it's always a question of risk on one side and opportunities on the other side, and short-term, long-term. And, when you do investment and construct portfolios for the short and long-term, you need to balance these two. So I think the risks are pretty obvious and they have quite an impact. Phoebe, you mentioned flooding, for example. So you can easily imagine what the impact could be in the production chain of a company. But then as well, we can think about, we were mentioning before, energy transition and energy security as well. And the fact that we need to rewire the energy so we don't have any disruption, so we are not affected as well by different blocks. But it's kind of the same thing for the climate change. So on the opportunity side, we will probably see some things here as well, a lot of investments. So these are ways basically to mitigate these risks somehow. As well, all this big energy rewiring will have an impact of, let's say, the green commodities that were mentioned before as well.
No, very good. And Patrick, anything from your perspective?
Yeah, I mean, climate change is really, really important to what we do. We ensure the real economy. We have a lot of natural catastrophe exposure on the liability side. So that is for sure something that we look at very, very closely with regards to, business interruption insurance, property markets, and these kinds of things. I think what Phoebe mentioned, just as a follow-up, I think is really important. We have done for our own portfolio also some risk assessments with regards to stranded asset risk, which is basically if you hold a physical asset and then as a result of changes in the physical environment, climate change, natural catastrophes, and so on, you can no longer achieve the projected cash flows of a company or a production site or whatever it is that you hold, and what the implications of that is. And that is doable if you have a geographic location and you can run some climate models on top of that, then that is very insightful. But for a lot of other aspects, it's just simply not possible. If you hold a benchmark, an equity benchmark like the S&P 500 or something like that, it becomes very crude, and it's difficult to really dig deeper into this kind of climate risk and what it really means. The way we are trying to think about this is, as I mentioned, looking at the stranded asset risk for the assets that have a geographic location and that we can locate. The other one is obviously around thinking, what do you invest in? We have assets that we manage. Our own assets are a bit over $100 billion, and all of them are managed according to ESG benchmarks, and we also measure the carbon intensity of particularly our liquid asset portfolio, so especially equities and credit that we hold, and we try to optimize for the carbon footprint in these asset classes as well, and not only the risk and return considerations. So I think one needs to think about climate change, ESG, but also the regulatory risks that you might face investing in certain areas, one or another, into account in the entire strategic asset allocation process.
No, very good, very good. And a twist on the friendshoring, reshoring, depending on where you're at and what company you're talking to. India is clearly one of these geographies that some would argue could benefit from the stresses and relationship between the U.S. and China. In technology, certainly, and in other businesses, it was one of those elements that, I'll harken back to that report that I had mentioned in terms of untangling the U.S.-China tech relationship that we had found. What do you think about India as a supply chain alternative, and other perspectives at this point? Clearly, that was the one market last year, in outstanding fashion that really stuck out versus pretty much any other geography from an investment vantage point. How do you feel about India now? Antoine, do you want to take this one first.
Okay. Yeah, well, it's interesting because currently I'm in Dubai and I'm meeting with a lot of Indian actually of origin, and everyone's talking about the boom in China, and basically that everything is quite going well, and that India, the same as China, is a bit and will be a bit too big to ignore at some point. So it's said that in the time of, let's say, the next 7 years, it will be the third global economy with a growing population that is able to speak English, that is educated, and that is really strong on tech. So it looks a bit expensive valuation-wise, but this is because they are twisted to the tech business. So it will be probably one of the winners of this, let's say, China plus one, and all the terms that were defined and mentioned by Patrick as well. So yeah, basically we are getting a bit more positive here regarding India, even though there were some short-term tailwinds regarding Adani, for example, but longer-term perspective, there should be good winners in here.
Oh, fair enough. Patrick, thoughts on this?
Yeah, by and large, I would agree with Antoine that the prospects are good. But as with many emerging economies, accessing the market is not as straightforward. So I think that's also something that one needs to keep in mind. But actually, we also see it on the insurance side that Indian insurance markets are growing very rapidly as a result of the larger population, people getting wealthier, and so on. So we for sure see a lot of potential there.
Yeah, and Phoebe, thoughts on this one?
I don't want to repeat too much what other people have said. The only thing I'd add is that they're also a beneficiary of cheap, sanctioned energy. So along with China, they have that sort of de-inflationary or stimulus effect to their economy and to manufacturing.
No, very, very good, and different perspectives in terms of the geopolitics and policy perspectives of what's transpired with the sort of rerouting of Russian energy. Certainly there's been an impact on the revenue to Russia, but that's because it's gone cheaply to India and gotten processed and turned back around. So intriguing perspectives there for sure. So thank you. I know we're running close to 45 minutes, and so I don't want to keep this too long and take too much of you all's time. But I did want to take sort of one last look at a longer term perspective. Around the work that we do in Bloomberg Intelligence, we're focused on the 3 Ds: deglobalization, decarbonization, and demographics, all being drivers of really a regime change, as we would see it, pushing an elevated level of inflation. Even if inflation pulls back from recent high levels, we don't foresee it going back to where we were pre-pandemic. And supply chain issues are certainly an important issue for the deglobalization or reglobalization, however we want to phrase that, and play over into the other 2 factors as well. But what are you and your teams thinking about in terms of the longer term trajectory on inflation, given some of what we've talked about broadly speaking here? Patrick, do you want to take this one?
Sure. Yeah. So first of all, we do believe that we're entering a decade of structurally more elevated inflation as a result of the things that we had discussed just before. Now, this doesn't mean that we need to see 5% of inflation every year going forward, but still slightly above 2% inflation is our base case as a result of these supply chain reconfigurations, net zero transitions, and other aspects. And if you think about, for example, 2.5% inflation compared and compare that with the roughly 1.5% inflation that we had over the past decade, it doesn't sound like a lot, but from an investment point of view, this inflation wedge actually adds up and accumulates quite a bit over the years. But I think what's important is that it also forces a different public policy response going forward. And what I mean by that is that after the GFC, monetary policy was always able to come to the rescue of markets because quantitative easing was justified because inflation was below the central bank's target level. But if inflation is 2.5% and structurally running just a bit above the central bank target level, then the financial market intervention becomes a lot more difficult to justify, which means that there are still instances where you could have financial market intervention, for example, when market functioning is no longer guaranteed. But it does mean that the central bank safety net, or as many people call it, the central bank put, is just much further away over the next decade compared to what we had experienced over the entire last decade. And one might argue, well, it's a subtle change. It might be, but it's an important change.
No, very good. Patrick, thoughts on this one yourself? I'm sorry, Antoine. Excuse
Antoine.
me.
So, Patrick, we are listening to you again.
Yeah, exactly. I'm looking at Antoine, but I said Patrick. So.
Yeah, by the way, Tim, I'm looking forward to receiving the report you mentioned almost 3 times.
Very good. I will do.
So it was a good teaser, so I will be happy to receive it. No, I think I mostly agree with what was said by Patrick and yourself. We have basically a new decade here. New things will unfold, and we are basically coming into like a kind of new normal regarding geopolitics, reorganization of the world, the East-West divide, energy transition, and so on. I don't want to push too much on that, but all agreed with you that structurally inflation should be higher than what it used to be pre-COVID. So this is basically a new world we are entering now. And I would say that on maybe on a more positive note regarding inflation, is that we might see as well some, we don't have to forget some good things that might happen, like productivity gain, for example. There is a lot of buzzword regarding artificial intelligence, for example, at the moment. Exactly. Not the other one. And so this might happen as well, and this might come into play in this new world described regarding reshoring, allied shoring, and so on. So this is one thing. Demographics as well. So we might see some changes here, secular changes as well. So birth rate tends to lower down. Some countries are actually to the verge of decreasing. So this will have very high impact. So we are pretty concerned about this one. Decarbonization is the one last thing. So we'll see some very, very interesting thing here, especially when there is like a supply constraint.
Oh, very good. And Phoebe?
I guess take a slightly different angle. There will obviously be businesses and probably sectors, but more specifically businesses within sectors that can deal with this higher inflationary, and whatever we mean by that, certainly higher than what we've been used to over the last decade and a bit, and higher interest rate, again, relative to the last 12 years or so, environment better than others. And investing in those businesses or avoiding the companies that it's probably quite clear which ones those are going to be that can't tackle that inflationary pressure or can't tackle that increased cost of capital. When we've got more certainty as the day goes by, mathematically, that we're getting closer to understanding what the terminal rate is going to be in the US, we have more clarity on which businesses are going to be the winners and the losers. And this is probably not as long term as you wanted me to answer the question, but we're still talking a few years here, realistically. And it's our role, we would see it as asset allocators, as selectors of investments and companies, to be able to identify or have a good chance of identifying companies that are going to be the winners, or at least not the ones that are significantly at risk as a result of this very different environment that we find ourselves in.
No, very good. Well, look, Phoebe, I would totally agree as well. And I don't think that I could have couched anything better to bring our discussion to a close. So very, very good on you. I do appreciate everybody's thoughts. We covered an awful lot of ground, and certainly it seems like all three of your firms, and I think ours as well, have an awful lot more. It's kind of the tip of the iceberg, but it nonetheless brings up an interesting discussion, and we really appreciate you all sharing your thoughts. We'll look forward to hopefully seeing you all in person, and those of you all who have listened. There are a host of Evenco events around Europe over the course of this year. The first one's coming up in just a couple of weeks in Copenhagen, and certainly we look forward to seeing any and everyone in our London office at Bloomberg if you happen to be in town. And we'll go from there. Much appreciated. And yeah, we can bring things to a close here. So thank you all very much.
Great. Thank you very much.